Raymond retired at 65. 36 years as a process engineer at a manufacturing plant outside Detroit. He had a traditional IRA worth $580,000, a small company pension of $540 a month, and a Social Security benefit of $2,800 a month. On paper, he was in better shape than most retirees his age. Then he turned 68 and he started pulling from the IRA. $40,000 the first year, $40,000 the next. He filed his taxes through the same accountant his company had always used, and everything looked fine on the forms he signed. But what Raymond never saw was the other $11,900 walking out the door every single year, money flowing out to the Internal Revenue Service, to the state of Michigan, and into the complexity of a retirement tax code that nobody ever sat him down to explain. Raymond is not unusual. Raymond is what happens when a retiree with a traditional IRA crosses 65 without a specific tax plan built around the rules that are now quietly working against him. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Nothing in this video is a recommendation for any specific financial product, account, or action. The numbers and examples are illustrations drawn from public tax rules, and your own situation is going to look different once you sit down with the actual forms and the actual balances that belong to you. My name is Kevin Retires. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through exactly how the Internal Revenue Service is quietly taking nearly $12,000 a year from most retirees who have a traditional IRA and are over 65. Not through one single bill, but through 5 quiet drains that stack on top of each other so smoothly that most retirees never see any single one of them. I'm going to walk you through each one, the dollar amount it costs, the rule or threshold that triggers it, and the specific decision that stops it. By the end of this video, you will understand the exact path Raymond walked, and you will know which of these 5 is probably happening to your own retirement right now. And this is not a theoretical walkthrough. The money is moving out of accounts like Raymond's this quarter every time a retiree files a return or takes a distribution without understanding what the tax code is doing to them in the background. Most of these rules do not come up in conversation with the average accountant because they require specificity. Your age, your state, your filing status, your income mix, the timing of each decision, and your accountant is usually working through hundreds of returns and does not have time for that custom walkthrough, which is exactly the conversation we are about to have. Before I break each one down, here is what I could not fit into this video. There are 3 specific worked examples I walk through step by step in the full retirement tax documentation. 3 scenarios with complete, year-by-year, numerical walkthroughs that just do not translate to video form. The first is a 68-year-old single retiree with $580,000 in a traditional IRA, the exact withdrawal schedule that combines qualified charitable distributions, the senior bonus deduction, and pension timing to keep provisional income below the 85% Social Security taxation threshold. The second is a married couple, ages 68 and 70, with $720,000 in combined traditional IRAs. The 2-year strategy before required minimum distributions kick in that redirects $18,000 a year into tax savings. The third is the state-by-state tax cost comparison on a $40,000 annual IRA withdrawal, showing the exact dollar difference between the highest tax states like California and New York and the zero income tax states like Florida and Tennessee. All 3 are in the retirement tax research, and the link is in the description. First link right at the top. If you are serious about not making the mistakes I'm about to describe, that documentation is where the full numbers live. Let me get back to it. So here are the 5 quiet drains. 1. Every dollar you pull out of a traditional IRA is taxed as ordinary income at your current marginal rate, not at the capital gains rate, not at some reduced retirement rate, at the same bracket you would pay if you were still working. For Raymond, single filer in 2026, his $40,000 IRA withdrawal stacked on top of his Social Security, and his pension pushed him into the 22% federal bracket. And here is what most retirees assume, that the senior bonus deduction takes care of a big chunk of that automatically, but it does not. The senior bonus deduction is $6,000 per person. It applies only from 2025 through 2028 under the One Big Beautiful Bill Act. And it starts phasing out once adjusted gross income crosses $75,000, single or $150,000 joint. Raymond was right at that cliff, and he lost part of the deduction without ever knowing it existed. About $1,320 a year in federal tax he did not need to pay. If this video is helping you see something that was invisible to you before today, something your advisor or your CPA has never walked through this clearly, hit the like button right now. It tells YouTube to show this to more retirees who need to see it. And if you have not subscribed yet, do it now and turn on the bell. Now let me keep going. 2. The withdrawal pushed his provisional income high enough to make most of his Social Security taxable. Provisional income is a formula the Internal Revenue Service has used since 1983. Your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. Once that number crosses $34,000 for a single filer, up to 85% of your Social Security becomes subject to federal income tax. Without the IRA withdrawal, only a small portion of Raymond's Social Security would have been taxable. With the $40,000 withdrawal layered on top, roughly $28,500 of his benefit became taxable, and the tax on that extra $17,000 or so of newly taxable Social Security came to just under $3,800 for the year. Almost $4,000 in federal tax he would not have owed at all if that withdrawal had been structured differently. 3. Michigan charges a flat 4.25% state income tax, and Raymond's IRA withdrawal flowed straight through that calculation. On a $40,000 withdrawal, that is another $1,700 walking out the door, while retirees in Florida, Texas, Tennessee, and Nevada pay exactly zero on that same withdrawal. Same $40,000, same IRA, same age, same need, and anywhere from $0 to $4,000 in state tax, depending on where you live. 4. Raymond gave $15,000 a year to his church, and he wrote that check from his checking account the same way he had for 30 years. And he got a tax deduction for exactly zero of it because he takes the standard deduction. If he had instructed his IRA custodian to send that $15,000 directly to the church as a qualified charitable distribution, that money would have left his IRA without ever hitting his tax return. No federal tax on it, no state tax on it, no impact on his provisional income or his senior bonus phase out. A retiree age 70 and a half or older can route up to $115,000 a year from an IRA to qualified charities this way. The cost to Raymond of not knowing this tool existed, about $2,800 a year. 5. Raymond is 68, and his required minimum distributions start at 73. When RMDs begin, the Internal Revenue Service will force him to withdraw a specific percentage of his IRA every single year, calculated from the Uniform Lifetime Table and Publication 590B. On a $580,000 IRA at age 73, that first required distribution will land at just under $22,000, whether he needs the money or not, whether his tax situation can absorb it or not. Because Raymond is doing no Roth conversion in the 5 years between 68 and 73, his entire IRA will be distributed under force, in a bracket likely to be higher than the one he is in right now. The difference between planning those distributions now and being forced into them later for a retiree in his situation comes to roughly $2,300 a year in unnecessary federal tax once RMDs kick in. Add them up. $3,800 for the Social Security taxation he did not need to trigger, $2,800 for the Qualified Charitable Distribution he never made, $1,320 for the senior bonus deduction he let phase out, $1,700 for the Michigan tax on a withdrawal he could have structured differently, and $2,300 for the Roth conversion window he is not using. $11,920 every single year, walking out the door quietly, while Raymond sits with his accountant once a year and is told everything looks fine. Let me show you what the other side of this looks like. Take 2 retirees, both 68, both with a traditional IRA of $580,000, both collecting $2,800 a month in Social Security, both drawing a $540 pension, both giving $15,000 a year to their church, both single filers in Michigan, both needing about $40,000 a year from the IRA to cover expenses. We will call them Raymond and Helen. Raymond does what most retirees do. He pulls $40,000 from the IRA in a single February withdrawal, writes his church check in December from his checking account, and files his taxes in April. Helen does something different. She has her IRA custodian send $15,000 directly to her church as a qualified charitable distribution. No hands, no checking account, straight from IRA to charity. Then she pulls only $25,000 from the IRA to cover her actual cash needs, split across 2 calendar years so no single year takes the full hit. She also converts $8,000 from her traditional IRA into a Roth the same year, paying the tax now while she is still in the 12% bracket, protecting future years from being forced into the 22% bracket when RMDs begin at 73. Same income needs, same lifestyle, same charitable giving, but the numbers look nothing alike. Raymond's combined federal and Michigan tax bill that year is roughly $14,200. Helen's combined tax bill is roughly $6,900. $7,300 a year between 2 retirees doing the same things with their money, in the same state, with the same checkbook. Over 20 years of retirement, that is roughly $146,000. Different decisions, not different circumstances. Now, I would not be doing my job if I did not give you the honest version of this. The Roth conversion strategy does not work the same for every retiree. If your income is already near the Medicare IRA threshold of $109,000 for single filers or $218,000 for married couples, a conversion could trigger a Medicare premium surcharge 2 years later. And some states tax Roth conversions at the moment of conversion, even when the federal code handles them smoothly, which means the state tax calculation has to be run before you commit. These are decisions that need to be run through your specific numbers before you act on them, and that brings me to your checklist. Here is your action checklist, 7 steps starting this week. Step 1. Pull out your most recent form, 1040 or 1040 SR, find line 11 for your adjusted gross income and add half of your total Social Security benefit from line 6A plus any tax-exempt interest. That number is your provisional income. Write it down. Step 2, go to irs.gov and search publication 590B for the Uniform Lifetime Table and divide your current IRA balance by the factor for age 73 to see exactly what the IRS will force you to withdraw when required minimum distributions begin. Step 3. If you give money to charity every year and you take the standard deduction, call your IRA custodian and ask for the Qualified Charitable Distribution request form. Because starting at age 70 and a half, you can route up to $115,000 a year straight from your IRA to a qualified charity without it ever appearing on your tax return. Step 4. Confirm whether you are receiving the senior bonus deduction on Schedule 1A of your return, $6,000 per person if your adjusted gross income is below $75,000 single or $150,000 joint, phasing out as income rises, and the entire deduction disappears permanently at the end of 2028. Step 5. Check your state's specific treatment of IRA withdrawals. A few states exclude retirement income entirely, many tax it at the full rate, and a handful have partial exemptions based on age or income, which may reshape which account you draw from first. Step 6, if you are between 60 and 72, calculate how much you could safely convert from traditional to Roth each year without crossing your next federal bracket, the senior bonus phase out, or the RMA threshold that sets your Medicare premium 2 years later. Step 7, take this list to a qualified tax professional who actually specializes in retirement taxation. Not a general tax preparer, not the same accountant your company used for 30 years. That conversation is usually a few $100s. And the difference on the other side of it is often $100,000 or more over the rest of your retirement. Here is what I want you to take away before I close this out. The money I just walked you through is not hiding. It is not in some offshore account. It is not the result of bad luck. It is sitting right inside the decisions you make between now and the day you die, across every tax return, every IRA withdrawal, every charitable check, every year you delay a conversion you should have planned. And the only thing standing between most retirees and the difference between Raymond's path and Helen's path is specificity. Specific numbers, specific forms, specific timing, which is exactly what a 15-minute April conversation with a general tax preparer is not built to give you. Drop a comment and tell me, how much are you currently pulling from your traditional IRA each year? And did anyone ever walk you through the actual tax impact of that withdrawal before you started doing it? I read every single one, and the most common situations become future videos. Before I close this out, here is one more thing I want sitting with you once you walk away from this video. Because this is the part that most retirees miss after they finish watching something like this, and I do not want you to be one of them. Every one of the 5 drains I just described is fixable. Every single one of them. But none of them get fixed by leaving your financial life on the same pile, with the same accountant, filing the same return in April that you filed last April, and hoping that 2028 arrives before anyone realizes the senior bonus window is about to close forever, because that window closes on December 31st, 2028, whether you planned around it or not, and the retirees who actually take action in the next 18 months will capture thousands of dollars that the retirees who wait will simply not. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. And if you know someone who has a traditional IRA and is over 65, send them this video today. The difference between knowing this and not knowing it could be $100,000 or more over the rest of their retirement. I'll see you in the next one.